time to move on now and welcome on board Aman Chowhan, Abakkus Asset Manager LLP. He's here to talk about how he is viewing the market right now and what the portfolio strategy is amid a tumultuous market like this. And Aman, good morning and thanks so much for joining us. And first up, that's what I want you to address. If you could share with our viewers, what are you making of this entire Trump tariff tirade that we're seeing right now? Because one day you have tariffs, the other day they're receded back, and the impact that it has on global markets and our market back home as well. What should an investor's strategy be, and how should you be positioning yourself in a market like this so as to be able to absorb these shocks without much impact to the portfolio?
Sure. So, see, one thing is very clear that we are in uncertain times, and what is the degree of uncertainty, that is what keeps on changing on a daily basis. Having said that, what happened over the last 2 days is that once this 90-day deferment, people now know what the worst case scenario is as to what is going to be the tariff, except for what is going to happen on China. Now it is very clear that whatever Trump has announced, the eventual tariff is going to be same or lower than that, unless there is something which is a trade war kind of thing which can happen with China. The X of China, we now know what the worst case scenario is, and things can only be better or same as when they were. So keeping that in mind, there is some clarity, and that is the reason what we see is a relief rally or whatever you can say, short covering or technical factors behind this rally. Now, since the outcome is not as bad as feared, there could be some buying also which can come in. But at the same time, the overall uncertainty remains because China is the largest trade partner of US, where there's still a very high tariff, and there's also a retaliation tariff from both China and US, and that is obviously going to lead to inflation in US, and how they're going to handle is something that people are still unsure about. So keeping this in background and keeping that the economic activity in US is also slowing down because of this uncertainty and the, you can say, looming inflation coming in, we suggest that anybody looking to invest into in India or overall into equity markets should not come in right away. They should stagger it over the next 2 to 3 months. So come in, but only with a portion of your investment that you want to do, and do it over the next 3 months. I'm not advocating a 12-month or a 20-month SIP kind of a model, but over the next 3 months, whatever needs to happen and the new reset that needs to happen on the global trade would be there. And there could be volatility because of that. One can take advantage of that volatility and place the trades or the investments in a staggered 3-month period.
All right, so wait and watch and rather take the next 3 months as an investment opportunity. But Aman, good morning. This is Shrishti also joining in. Aman, you have seen so many cycles in the past and so many tough cycles, I would say, be it 2008, 2020, and now we are sitting in 2025 with all this uncertainty around. And given the move in the markets, or rather the carnage, Aman, in the people's portfolio when it comes to the mid end of the market, give us some sense that are you also concerned about those heightened volatility or that kind of a correction to trickle in? Because what's the signals that we are getting, be it from the bond market, be it the uncertainty around how China is going to retaliate, and what could be the impact on the emerging markets like India. Help us understand that. Are you also relating to those cycles, or maybe this time is different?
Every time is some other trigger or some other reason for the market volatility. What we have seen so far has been trade barriers and what the US is planning to do. Going ahead, the volatility will most likely will come from how the bond yields function, and more importantly, how the currency functions. Because now, once the tariffs are decided, then how the you can say neighboring countries will decide on how their currency movement is going to have a bearing on INR also, and that is going to be the next source of volatility, is what I feel. So that's now the backdrop is. One thing that we feel right now is that in the past, when COVID happened or when Brexit happened or the other issues happened where market had a very sharp correction, we saw a very swift pullback from the market. So we had a 3, 4, 5-day correction, and then the market recovered very sharply. That was a V-shaped recovery, which doesn't look like in the current scenario, at least for now. It looks like we'll have a gradual recovery whenever the recovery happens, because the Indian economy is also gradually picking up. So we had a slowdown, government has taken measures to address that slowdown, and the benefits of those measures will be visible over the next 3, 6, 9 months, right? So there's no immediate hurry for the Indian markets also to see a very V-shaped recovery if that happens globally. So that is something which is one thing that I can tell you, that's what the current view is. that it's going to be gradual. So in that scenario, there is no tearing hurry to buy into a large cap or a mid cap. Each one can time the investments, select the sector that they would like to invest, and position their portfolio accordingly.
Okay, so if that's the approach, Aman, going ahead or even right now, could you help us understand how your portfolio is placed at the moment? What are the sectors you like and which ones are you avoiding at the moment? And also, what percentage of your portfolio is in cash or, let's say, commodities like gold?
Sure. So we don't invest in gold. We don't take cash calls. So roughly, we have multiple schemes. Depending on that, the cash should be anywhere between 5 to 15%. It's not something which is a cash call that we take. This cash is waiting to be deployed kind of scenario that we have. And among the sectors, you can the three large sectors that are directly impacted because of this global is metals, IT, and pharma. Within that, all these three sectors would be say mid to high single digit in the portfolio. We have not taken any, you can say, major stands for these sectors per se, because as we all know, it is uncertain time. There is no certainty for me to add to it or to take a zero exposure to these sectors. So they remain between 5 to say 10% of the portfolio. We are pretty comfortable with what we have. Only thing which I can tell you over the last 3 months, we have not added to these three sectors. So what we have added in the last 3 months would be financials, would be say something like a cement or an engineering company or an EPC company, something which is completely domestic focus, or maybe a consumer name kind of thing. So the three sectors that has maximum impact is something that we have not added, but holding on to what we already have.
Did highlight the three sectors that you have added in the past 3 months, but if you can give us some sense that what looks interesting to you for the next 3 months, because yes, of course, the next 3 months going to be really interesting. A clear verdict on the tariff is something that the global markets are expecting for. The earning season is through, but given the valuation comfort and given the sector outlook, help us understand the sectors that are looking interesting.
So financial is something that we like, predominantly the private banks and the NBFCs. Within that, recently the preference has changed from large private banks, which we continue to own and will continue to own in the near term also. But incrementally, we're adding more towards the mid-sized private banks and NBFCs. So that's where incremental money is going. On the fringe, we have added to cement, we have added to some consumer names. These are consumer discretionary, not consumer staples. And some engineering names, basically companies where the export exposure is minimal.
Where the export exposure is minimal and be a bit more domestically focused, that's the consensus call for now coming in, Aman. But help us understand that within that, any sector that you wish to flag off, because what we are getting to understand, maybe power, maybe telecom as a space you can look at. But what is your sense that apart from what's been happening globally, domestically, which sectors are well placed?
So we added to cement, where we feel there could be some pricing discipline and some pricing improvement which can come in. And in the next few quarters on a low base, and numbers can look better. Valuation comfort is there. We added to EPC companies, the government ordering, which had slowed down due to elections, has now come back. Most of these companies have seen acceleration in their order book position. That is something which is looking good. These companies trade at 10 to 15 times 1 year forward multiple, which is also something which is pretty comfortable multiple. So these are the sectors that we are pretty comfortable. Within consumer discretionary, we have added to say something on the beauty side. That one, we are looking at companies with AC exposure, or say electronics, or say white goods kind of exposure, which will benefit from the better consumer sentiment that we're expecting to see once the lower income tax, which the government has announced, starts being effective from current month onwards, as well as the EMI, which is going to be lower because of the rate cuts. So we see better consumer demand coming in these sectors, and that is where the incremental money and the incremental focus is.
Okay, on that note, Aman, we'll let you go. Once again, thanks so much for joining us and sharing your strategy on how to navigate the market, like a volatile market like this, and the sectors that you're liking at the moment. Thanks once again for joining us.
Thank you.
If you like this video, then like, share and subscribe to ET Now.